Hey there. Welcome to the 2022 first half of the year portfolio update. It's been an interesting year so far. The last time we sent a video to you, we talked about the idea that beginning of the year was going to have a couple of potential corrections. We've seen a correction so far year to date. We interrupt this video to bring you an update. We originally shot this video a few weeks ago, but now the world has changed. Things are changing a little more quickly than we had anticipated. The inflation number came out a little stronger, and the Federal Reserve raised interest rates by 75 basis points instead of the anticipated 50. This caused some uncertainty and shook up the equity markets. In the original video, we talked about the idea that this was a correction. It's probably more than a correction. You'll notice at the beginning of the video and towards the end, we talk about us being in the midpoint of the business cycle. That was one of the reasons for the update. I think we've moved past the midpoint of the business cycle, and the market doesn't necessarily know exactly where we are in the business cycle. We don't know how high interest rates are going to go. We don't know exactly when inflation is going to roll over and start to come down. The only thing that we do know is that market downturns are temporary. You're going to get your statements here in a few weeks, and your portfolios are going to be down. I understand that can be disconcerting. I want to assure you that we will continue to monitor markets and take the steps needed in a prudent manner to allow us to manage your portfolios in the most effective way through this challenging economic time. As we look back in history, every time we've had a down market for the first 100 days of the year, 22 out of the last 24 years, the market has been up 24% in the next 6 to 12 months. Don't know if that's going to happen this time. There are 4 factors that are affecting the economic environment currently. The first is China. The second is the Russian-Ukraine conflict. The third is the Federal Reserve. And the fourth is inflation. China locked down their major cities and now are starting to open up. Hopefully, that will continue. The Russian-Ukraine conflict has gone on longer than most anticipated. And at some point in time, we hope that there will be a peace treaty or some kind of ceasefire. That would be a positive aspect for the markets. The Federal Reserve. The Federal Reserve is in a rate tightening cycle. We talked about this in our last video. The idea that we're in the midpoint of the business cycle, and at this point in the business cycle, interest rates start to rise. The Federal Reserve is being a little more aggressive than we had anticipated because of the fourth factor, inflation. It feels like 1974 again with inflation. Everything seems to have gone up in price. Gas, airline tickets, food, it's affecting everyone. And the Federal Reserve is concerned. That's why they're raising interest rates to slow that demand on the demand side. But the thing they can't control is the supply side. Labor markets are strong, but there are still supply chain shortages, and that is having an effect on inflation. Both sides of that equation have to change in order for inflation to come down. The big question is, how much rate increases does the Federal Reserve have to put in place in order to slow that demand for inflation to come down? Question is, will they pause in the fall? If they don't pause in the fall, things might get a little more challenging. If they do pause in the fall, we might orchestrate a soft landing and things might get better. There's a little bit of confusion in the marketplace right now. We don't know exactly what's going to happen. But we position your portfolios in a way we're a little more defensive in this environment. Some of the changes that we made back earlier in the year is we added energy, we increased large cap value in our portfolios, we added commodities, and we increased cash. All looking back were positive moves. We have had a stronger downturn in the NASDAQ and the S&P 500 than we would have anticipated. But we're still underweight those areas and anticipate that the market will probably, if we can orchestrate a better case scenario, improve as we come into the fall. We're going to rebalance the portfolios coming up in the next few weeks. I'm very comfortable with the positions that we have in the portfolio currently, but we will be diligent in changing things if we need to as the economic and market environment dictates. As always, we value your relationship with us, and we look forward to continuing to serve you. Stay safe, stay healthy. God bless.